Since a lot of people have a little confusion with respect to convertible bonds, warrants, options and ESOPs, let's just understand the basic difference between all these four terms. When you're looking at a convertible bond, the bondholder is supposed to give the bond to the company and it is voluntary. It's the choice of the bondholder. If he wants, he can give the bond to the company and the company is going to issue new equity shares. It's not the existing shares in the market. So the bondholder is supposed to give the bond to the company and the company is going to be giving you new equity shares in return. The bondholders got the choice. A convertibility option is embedded in the bond. You cannot separate the bond and the convertibility part. You cannot keep the bond and have the shares too. It's not possible. It is a convertible bond. At the choice of the bondholder, you can give the bond and exchange it for new equity shares. The equity share capital of the company is going to increase. There is going to be dilution of stake. And that is how we calculate diluted EPS, whether the bond is dilutive or not. We will calculate it based on whether the bondholders are getting more income today, or if they convert it into equity shares, will they have more income then. So that is how we calculate whether the convertible bond has dilutive property, dilutive effect or not. If it has dilutive effect, only then the diluted EPS will be having that impact and it will be lower than your basic EPS, because the choice is with the bondholder. The bondholder will only convert if the amount of interest that he is getting today is actually lower than the amount of income that the earning per share, that the shares can generate post the conversion. The number of shares that a per bond is convertible into is decided from the beginning when the bond is issued. When you're looking at the warrants, bonds and warrants can trade separately. So basically, in order to sell bonds, issue bonds, in order to make the bonds more attractive, in order to be able to raise money by issuing bonds in the market, in order to reduce the interest rate, the coupon rate on the bonds, at times the bonds can be issued at lower coupon rates, but then they have warrants attached to it. Warrant basically gives a right to the warrant holder, to actually pay the exercise price of the warrant and get shares in return. So basically, say for example, the warrant's exercise price is, let's say, at 20. So in case the share price goes above 20, the warrant holder can exercise the warrant rights. He can pay 20 to the company and get new shares in return. It is not the already existing shares in the market. The company will get the exercise price. The company gets the money and the warrant holder will be given, the shares at the exercise price, and they can sell it in the market at a higher price. Of course, it's working like an option, but it's not exactly an option, because in case of an option, the option buyer is going to buy the shares from the existing shares in the market by paying the exercise price to the option seller. In this case, there are new shares that is being issued and you're paying the exercise price to the company directly. Warrant and bond can be traded separately. Warrants are also known as sweeteners. Basically, it makes the issue of bonds easier. You can issue the bonds in the market easily because they have warrants attached to it. So warrants are attached to the bond. It is not embedded in the bond. So warrant is also very much like an option which you're selling it with the bond in order to package the bond and be able to raise money using the bonds and all. But in case of warrants, the exercise price is going to the company, which is a major difference, and new shares are being issued. When you're talking about normal options in the market, the call buyer gives the exercise price to the call seller, and the call seller is obligated to give the shares to the call buyer. There is no new shares that are paid to the call buyer. It is the existing shares from the market that are purchased and given to the call buyer in case the call seller did not already have the existing shares. So it is the existing shares that the call seller is supposed to give to the call buyer. The company does not get any money, no exercise price, and the company does not issue new shares. There is no dilution of any stake, any control, any EPS or anything. In case of ESOP, what happens is the employee is going to pay an exercise price to the company and he has the right to exercise a share. He is going to get new equity shares from the company. The exercise price is given to the company over here. Of course, the employee is given an ESOP with a vesting period and all, so as to make sure that the employee is staying for a longer duration with the company and the alignment of interest is happening better, because the employee is going to be working for the benefit of the shareholders in order to increase the share price in the long term. So he's not even looking at the short term risk taking and all. So that is quite a good way. But then, since new equity shares are given, of course, at a lower price, generally say suppose today's the share price is 260. So in that case, the employee will get the right to buy the share at 260 after 3 years. So in that case, the employee will work very hard in order to increase the share prices over the 3-year period. Over here, new shares are issued, therefore dilution is going to happen. And since you are going to be issuing shares to the employee at, let's say, 260, when in future, assuming that the price has become 300, so there is an option cost. The employee is getting the option to buy the share. It is not a compulsion over here. So that option price is basically a part of your salary expense, because in order to induce the employee to work harder or work Say for example, without the ESOP, the salary could have been 12 lakh, let's say, or 12 lakhs, and with the ESOP, you are able to give a salary only of 11 lakhs. Basically, the option value should be somewhere around 1 lakh, hypothetically. So that is going to be a part of your salary or your compensation paid to the employee. New shares are issued and there is a dilution that is happening over here. That's the basic difference between convertible bond, warrants, options and ESOPs. Comfortable, everyone?